Darling, do you know what happens right before ordinary people accidentally become wealthy? Banks start telling everyone to be careful, and strangely enough, they are doing it again right now. They are whispering warnings to the masses while quietly rearranging their own balance sheets in the dark. There is a pattern appearing in the global markets right now that has only surfaced a few times in the last 50 years, and the people who understand it early usually stop worrying about money forever. The rest? They will spend the next 10 years paying for the consequences of their own hesitation. A few months from now, millions of people will look back and say, wait, the opportunity was that obvious. And most of them still won't act, because looking back is free, darling. But positioning yourself requires courage, and courage is the one asset you cannot lease. Most people think investing success comes from predicting the future. They imagine wealthy investors sitting in dark rooms with 6 monitors and suspiciously expensive espresso machines, trading the world away. But real wealth creation is usually much less glamorous. It often begins during periods that feel deeply uncomfortable, confusing, uncertain, a little ugly. The 1970s felt ugly. 2009 felt catastrophic. 2020 felt insane. And now? People are exhausted again. Inflation stretched household budgets until they snapped. Groceries suddenly feel like luxury items. Eggs became emotionally expensive, and every second headline screams some variation of crash coming. AI will replace everyone. The world is overheated. Darling, modern economists have successfully predicted 37 of the last 4 recessions. Fear is the most heavily manufactured product on Earth, and most people consume it willingly. But fear does something fascinating to financial markets. It discounts the future. It puts premium assets on sale for the few who can control their heart rate. While nervous people freeze, assets continue compounding, and compounding is an absolutely ruthless little creature. A single dollar invested in the S&P 500 in 1980 is now worth over $100 with dividends reinvested. $1 into over 100. That is not investing, darling. That is financial witchcraft with paperwork. Here is the truth most beginners completely misunderstand. The biggest money is rarely made during safe economic periods. Safety is an illusion sold to the middle class to keep them compliant. The largest fortunes are built during transitions, moments where the old system starts cracking and a new one quietly forms underneath. That is exactly what happened after inflation exploded in the 1970s. It happened after the 2008 financial crisis. And right now, we are watching another transition happen in real time. But don't blink, because if you look at the wrong variables, you will miss the entire shift. While the crowd is arguing about interest rates and political theater, a massive tidal wave of capital is quietly changing direction. And this is the part almost everybody gets wrong. They think opportunity means predicting the next NVIDIA or chasing some obscure tech stock. No, darling, that is gambling with better branding. The real winners during rare market setups are usually the people who simply stay invested long enough to become dangerous. Look at what happened after 2009. The financial crisis erased trillions. People panicked. Some sold everything near the bottom, cementing their losses forever. And meanwhile, quiet investors kept buying index funds every single month like emotionally stable psychopaths. From 2009 until today, the S&P 500 climbed roughly 900%. But let's take off the corporate filter and look at what that actually means for a human being. My friend Arthur, a private banker in Zurich, showed me the internal data for this exact period. He calls it the Great Disconnection. Arthur showed me a client who didn't just guess the market, she committed to a protocol. She dropped a 10,000 initial seed and added just $500 every single month, completely ignoring the media panic, the political noise, and the constant shouting. Her total out-of-pocket investment was significant, but because she stayed in the game while everyone else was running for the exits, her account balance today has crossed $550,000. Arthur looked at me and said, "The middle class thinks investing is about being a genius. It's not. It's about survival. The market doesn't reward the smartest person in the room. It rewards the one who is the most emotionally stable psychopath." The market does not reward drama, darling. It rewards endurance. But now comes the part that makes this specific setup unusual, even compared to 2009. Because this time, there is another force underneath the market, a silent multi-trillion-dollar engine. Over the next 2 decades, more than $100 trillion will quietly change hands, and most people think this means a few spoiled children buying yachts in Monaco? Darling, that is the Hollywood version. The real version looks far less glamorous. It looks like a 74-year-old landlord finally selling 5 properties he bought for the price of a modern parking space, a widow suddenly controlling more money than she ever expected. Millions of millennials may inherit homes worth more money than they earned in 20 years of work. Family businesses being sold because nobody under 40 wants to wake up at 5 a.m. to run a plumbing company anymore. And while all of this happens, trillions of dollars start moving out of old portfolios, out of bonds, out of safe money, and directly into the future. Technology, AI infrastructure, energy systems, healthcare innovation, data centers. The younger generation invests differently. They do not want the same world their parents built portfolios for. And that is the opportunity. Because when giant rivers of money suddenly change direction, entire sectors become rich almost by accident. Most people will only notice after prices explode. The smart investors notice while it still feels boring. Now, of course, some people will hear this and immediately start buying random speculative garbage because a boy on social media gave them a tip. Darling, if a man needs to perform success to sell you financial advice, he isn't wealthy. He's just high-end desperate. Don't fund his lifestyle at the expense of your own. Let me show you the mistake that quietly destroys most beginners. And it looks incredibly responsible on the surface, which makes it particularly lethal. Many people still believe cash is safe. Emotionally, yes. Mathematically, it's a tragedy. A person who kept $100,000 in cash since 2000 lost enough purchasing power to effectively erase an entire luxury car. If inflation averages just 3% annually, your purchasing power gets cut nearly in half over 25 years, meaning the money sitting quietly in your savings account is actually losing its power every single day. This is why wealthy people obsess over ownership. They own businesses, stocks, real estate, infrastructure. They don't want paper. They want productive assets. And before somebody comments, "But Margot, markets crash." Of course they do. So do people at pickleball tournaments, and they still show up the next Saturday. Crashes and wealth creation are not contradictions, darling. They are partners. The crash is the price of admission for the gains that follow. But there is still one final piece almost nobody talks about. And honestly, this is the point that separates the wealthy from the merely comfortable. People obsess over flashy AI apps because that is the sexy part of the story. But darling, everyone wants to own the AI app. Very few people ask who owns the electricity bill behind it. And historically, fortunes are usually built underneath revolutions, not on top of them. We've all heard the cliche about selling shovels during a gold rush, but let's be more precise for 2026. The new world doesn't just need software, it needs physical power. AI requires an astronomical amount of electricity, data centers, cooling systems, and specialized infrastructure. The companies building the grids, the fiber optics, and the energy supplies are the ones structurally aligned with the next decade. Successful investing is not about excitement, it is about alignment. You want to stand where the river is already moving, not where the crowd is shouting. So how do you execute this without losing your mind to the noise? You don't need a complicated strategy. You need a protocol. If you want the blueprint of the wealthy, it's simple. Automate the acquisition and cultivate a violent indifference to the news cycle. Pay your future freedom before you pay the landlord, the dinner, or the clothes. Make it so mechanical that it requires zero willpower. Anything else is just vanity. If you're checking your portfolio every 3 hours, you're not an investor. You're an addict looking for a dopamine hit. True wealth is built in the dark, while you're busy living a life that doesn't revolve around a screen. The people who become truly wealthy from moments like this always look slightly ridiculous early on. They appear too calm, too patient, too detached from the daily panic. Until suddenly, 20 years have passed and they quietly own the neighborhood. 20 years from now, people will look back at this period and swear the opportunity was obvious. They will say, "Of course AI changed everything. Of course those assets exploded. Of course the market recovered." Darling, hindsight is the cheapest luxury on earth. Everybody can afford it. But right now, people are still scared, still confused, still waiting for somebody on television to tell them it feels safe again. And that is exactly why the opportunity still exists. Because by the time the average person finally feels comfortable investing, the real money has already been made. The best assets are already expensive. The quiet investors are already wealthy. And the people who spent years panic scrolling headlines will suddenly wake up at 52, wondering why everything feels financially impossible. That is how wealth gaps quietly form in real life, not in one dramatic moment, but through 10 or 20 years of different behavior repeated over and over again. Because while most people were waiting for certainty, somebody else was quietly buying the future.